Stock futures are holding steady as investors await a critical inflation report. But the market's mood is far from calm. The battle's the interest rates, a tug-of-war between investors and the Fed. With the release of August's personal consumption expenditures price index looming, investors are on edge. This index, the Fed's preferred inflation measure, could sway the central bank's decision on interest rates. But here's where it gets controversial. Solid jobs data and a robust GDP revision have investors worried that the economy might not need the rate cuts they've been hoping for. The three major U.S. indexes took a hit on Thursday, and the 10-year Treasury yield rose, reflecting this concern. Major AI players like Oracle, Meta, and Tesla saw their stocks dip, with Oracle losing 5.6%, as some investors question the tech sector's lofty valuations. Week to date, the S&P 500 is down nearly 0.9%, with the Nasdaq Composite and Dow Jones Industrial Average also in the red. But not everyone is panicking. Andrew Sliman, head of Applied Equity Advisors at Morgan Stanley Investment Management, sees these dips as buying opportunities, especially in tech. He believes the pullback is healthy for the market, curbing rampant speculation. Costco and Concentrix, post-earnings analysis. Costco and Concentrix saw movement in their stock prices after Thursday's close, with Costco's shares dipping about 0.9% despite beating analysts' estimates for earnings and revenue. Concentrix, on the other hand, plunged nearly 22% in after-hours trading, missing earnings expectations and lowering its forecast. Fundstrat's Tom Lee, one rate cut left. Tom Lee, head of research at Fundstrat, believes markets can stay strong even if the Fed only cuts rates once more this year. He argues that a rate cut into a strong economy is preferable to a weak one. This perspective comes after market participants adjusted their expectations following Thursday's jobless claims data. Lee cautions against rushing into a new hiking cycle based on imputed shelter inflation, a point that markets might agree with. And this is the part most people miss. The Fed's decision on interest rates isn't just about inflation. It's a delicate balance between economic health and investor expectations. So what do you think? Is the market overreacting to the possibility of fewer rate cuts? Or is this a sign of a healthy economy? Let's discuss in the comments.